All right, good day. I hope each and everyone is doing well. So today we are going to look at a basic concept under manufacturing known as the provision for unrealized profits. If you say unrealized profit, what does it mean? And what is the rationale behind the accountant making this provision? And ultimately, we know what a provision means in accounting. When you say a provision, trying to timing of an uncertain amount, you are going to give something, but you are not sure. It's like an estimate. That's a basic explanation. So, provision, we already know what a provision means, and let's say unrealized profit. At the end of the day, the sole aim or one of the prima facie objective for the manufacturer going into production or producing the goods by himself or herself is to actually get profit. And the profit from this type of business emanates from the two sources, as we keep on saying. One is a profit made under the normal sales to outsiders, and also the profit that you get when you decide to integrate backwards. Okay, you used to buy the goods from outside, and currently you've decided that instead of going to buy the goods from outside, you are not going to do that. You are going to manufacture yourself and sell it. So when you manufacture and you're able to put things in place, you are efficient in your production, definitely you are going to get what we call manufacturing profit. And after also selling it too, there's some profit that you are going to make. Okay, sometimes some business engages, certain business engages in these activities and it doesn't go on well for them. And that is what we want you to know. When you manufacture the goods, after the manufacturing or the production of the goods, you will definitely add profit to the goods. So we have cost of production, and let me say this is the cost of production. Then you add manufacturing profit. So when you add the manufacturing profit to your cost of production, then you arrive at what we call market value. This is the amount of goods that you want to sell. That's what we call market value. How much you can acquire these goods on the market. That's the fair value of the goods you've produced. What if at the end of the day, or at the end of the period, at the end of the month, or at the end of the year, you're not able to sell all the goods you manufactured? Then you are going to get what we call closing inventory of finished goods. Closing inventory of finished goods. It is as a result of this closing inventory of finished goods that the accountant is going to take a look at this provision for the unrealized profit, because you were not able to sell all the goods. In accounting, we always say that revenue should be earned, meaning that if all the process that should lead to the end user or the customer acquiring the goods have been completed, then we will say that revenue or income has been earned, not only when cash is being received. But if at the end of the period, the owner or the manufacturer is still having some of the goods at his or her premises, then we have to make provision for the unrealized profit. So let's say that at the end of the year, our cost of production was 100,000. And the manufacturing profit was 50,000. Our market value will be what? 150,000. Let's find out the provision for unrealized profit. At the end of the closing finished goods, we couldn't sell all the goods that we manufactured. So that one too was, let's put it in Ghana cedis, that one was 40,000 cedis left. Since we have profit element loaded on these goods that we couldn't sell, definitely we are going to make provision for the unrealized profit, because we don't want to overstate our income. You couldn't sell all. You've captured this amount of goods in your statement. Why don't you derecognize that profit on the goods so that you you are not in the position of overstating your profit, and it has a lot of influence. If you overstate your profit, definitely there are other regulatory bodies like the GRA who will come in and let you pay higher taxes. Your shareholders will be expecting a lot of returns from your activity, but that is not so. Okay, at the end of the day, if you want to find a provision for unrealized profit, then we are going to say that if the goods, the market value, this amount of goods gave you a profit of how much? 50,000 cedis. Then the goods left, that is a 40,000. What will be the profit on that goods left? We don't know. I produce goods worth 150,000 Ghana cedis. It is giving me a profit of 50,000 Ghana cedis. Then, if 40,000 Ghana cedis of the goods are unsold or they are remaining at the end of the period, what will be the profit? It's simple mathematics. If 150,000 give me 50,000, then the 40,000 will be giving me what? Less. And if less, more divide, which will be 40,000 divided by 150,000 times the 50,000, which will give us 13,333 point something. So this is the closing provision for unrealized profit. So at the end of the year, the 40,000 worth of goods we were not able to sell is having a profit element of this. If you don't want to go by this format, you can also go by another one that you've been seeing. Maybe they give you a profit percentage of 50%. Because 50% of 100,000 will give you 50,000. So that was a profit percentage. And the profit percentage, if you apply 50% of the 100,000, it will give you 50,000. Any profit percentage expressed on cost is known as what? Markup. Any profit percentage expressed on sales is known as what? Margin. You can't apply this 50% on the 150,000. The reason is that this market value is the selling price of the goods you've manufactured. And for you to find a profit percentage on this, then we have to change the 50%, which is a markup, to margin. And in changing from markup to margin, what you do is that you add the numerator to the denominator. So 50 over 100 plus 50, which will give us 50 over 150. Let's find 50 over 150 times the 150,000. You see that we get a profit of 50,000. Okay, so let's take our calculators. 50 divided by 150 times 150,000 give us a profit of what? 50,000. But you can see that if you apply the 50% straight on the 150,000, you won't get a profit of 50,000 unless that 50% is applied on the 100,000. That is what we are talking about now. So we've all seen this. If they've given you, let's say, a markup like this question, 50%, it's so simple. If I want to get my provision for unrealized profit on the closing inventory, we know it is 40,000. Then I can apply the 50% straight on the 40,000 here, because this closing inventory of finished goods is in the form of a selling price or market value. Profit element is part of it. So I have to change the 50% to what? Margin. And markup to margin, you add the numerator to the denominator. Okay, so it will be 50 over 150 times the unsold finished goods, which is 40,000. And what will be the figure? Let's take our calculators. It will be 50 divided by 150 times 40,000. Supposed to give us the 13,333. So you see, it has given us the same figure, 13,333. So any method you choose, you get your answer. After finishing, after dealing with this, If in the question or in the trial balance, you already have provision for unrealized profit at the start, that is, you have a balance, opening balance, you compare the opening to the closing, then the one that you have worked for, PURP at the end, you compare the two. If the initial or the one at the beginning, let's say first day of the period, is higher than the one at the end, it means that then the provision has decreased. Let's say initially it was 200, at the end it's 150. You will see that there's a decrease in provision. Have you seen it? There's a decrease in the provision because it was 200 earlier on. The provision we made last year and beginning of this year is 200. It is always given first or first of the period or at the start, 200. Then the one you computed, let's say in this instance, ours was 1333. You bring 13333, then maybe the initial one was 20,000. It has decreased. And decrease in provision becomes what? Becomes an income. The reason why a decrease in provision becomes an income is because provision is a liability, and we all know that liability is a present obligation for you to transfer economic benefits. When it happens like that, what you have to understand, since the liability is going down, you are getting an income. But what if initially it was 1333 and at the end of the year it's 20,000? It has increased. Your liability has increased from 13,333 to 20,000. We will say it becomes what? An expense. Increase in a liability is an expense. If you have a loan of 10,000 and you are going to pay interest of 5,000 Ghana cedis, the loan is 10,000. The interest has increased the loan, which is a liability. The expense on the loan becomes what? An operating expense to the entity. So that is all for the provision for unrealized profit. So let me give a summary. If a question is being given and they say that in the additional information, goods manufactured are transferred to the income statement at cost plus 20%. You don't want to maybe use this formula that I did initially. If it is transferred at cost plus 20%, then that is a markup because they are saying at cost plus. And the only thing you can add or express on a cost is markup. So the 20% becomes markup. Good. If you have closing unfinished goods, that will call for your computation of the provision for unrealized profit at the end of the year. So if it is 20%, quickly scan through the question and get your closing inventory. Apply the 20% to the rule of changing from markup to margin. So the 20%, since the closing inventory is always at the selling price or at the market value, you change from markup to margin. So markup to margin, 20% becomes 20 over 120. If the question, they give you 10%, it will be 10 over 110. If they give you, let's say 15%, it will be 15 over 115. Apply it on the closing inventory of the finished goods. The figure that you get will be the profit element loaded on the unsold finished goods. When you are dealing with the income statement, don't deduct the provision for unrealized profit at the end of the year from the value of the finished goods, because the income statement is prepared based on the accrual concept. Whether it has been paid for or not, bring it. That is why the finished goods value we use in the income statement will still be the 40,000. But when you come to the statement of financial position, it is at a particular point in time. So we want to know the wealth of the asset or liability. And therefore, when you are going into your statement of financial position, you must deduct the 13,333 that we got from the 40,000 to get the actual cost of the goods remaining at your premises. That is a basic thing here. So please bear in mind. And the difference when you compare, if it is decrease, I said, will be part of the other income. If it is an increase, it will be part of your operating expenses. I believe and I hope you are going to get this. If you still have an issue, feel free to comment, give a comment, and like the video. Subscribe to the channel, and let's make a progress. Thank you very much.